the Women's Day, we have Nandita Parkar, Managing Partner with Karma Capital. She joins us live now. Nandita, welcome to the show and thank you for joining us. Happy Women's Day, Nandita. I must say that ET Now
Thank you.
wouldn't have reached
Happy
the way it
Women's
has
Day.
reached without the effort, joy, and the kind of fun which we have on a daily basis.
Oh, that's wonderful to know. And no, I'm really happy to be here. I'm very proud to be here. And I'm doing this, I think, for all the young ladies who are coming into our industry, and also for my daughter.
You know, normally I start with my market guest with a pointed question on markets, but I'm just simply curious to understand from you that when you decided to build your career in the financial market, what really uh, prompted you to enter into a sector which up until now has been largely dominated by Indian men and global men?
Yeah, so I was very idealistic when I was a teenager, and I was very good at math, and even if I say so myself, and I felt that this was one sector, financial services, at least Wall Street, where it was a meritocracy, and I felt that idea of a meritocracy and making it in a meritocracy seemed to me the way to go. So that was the idealism with which I started in this business, and it really proved right, because I felt that the people who encouraged me, obviously I was often the only woman in my team, or the only women on the floor on Wall Street, and so obviously there was a lot of encouragement from a lot of men, and a lot of advice and mentorship. And so I think that we've paved the way for women to and made it a little bit easier for them to come into the financial services industry, and I would encourage them to do that.
Great to hear your story, Nandita, and great to get you after a long chase of 1 year. We finally have you on Women's Day celebrating with us. Good to have you on the show. Let's talk about the market setup, Nandita.
I'm camera shy.
Is it giving you that uneasy feeling? Because you really don't know where this weakness is going to take you, right? I mean, after a great 2017, just about everyone knew that 2018 is going to be a volatile one, given our own domestic fundamentals. But you don't know where this is headed, because globally as well, things are getting all right. Just last evening, you have the U.S. Trade deficit reach a 10-year high. And now all the banter coming in from President Trump definitely doesn't seem to be doing us any good.
Right. So if you step back a little bit and you look at the end of 2017, we had a feeling that most markets were overextended, especially the Indian markets. And when I talked to my investors in the US, they had the same feeling about the US as well. When the calendar turned, what US investors were facing was suddenly very high increase in the 10-year, and US yields shot up overnight on early part of February. And so investors who had been really banking on the acceleration in the US economy led by the Trump tax cuts woke up and started pricing in about three Fed rate hikes in the US this year. And after a 10% drop in the S&P, we're probably at about close to pricing in 4 rate hikes this year. Now the good news is that these hikes are happening because the US economy is accelerating from the 2% type of growth that it enjoyed in the Obama years to 2.5% this year, and that's quite a move of the needle. In India, the setup is a little bit different. We are having much higher earnings growth this time. Part of it is the base effect from the poor show of the last few years, and part of it is that a number of sectors are kicking in to play their role in the economic upturn. So I think it's a mixture of both. So we have had a spate of domestic bad news as well. I mean, let's not forget that we did get slapped with a very surprise move of a 10% long-term capital gains tax, which shocked the market. That was the first thing. The RBI has been tightening the screws on NPLs, and then you had the Punjab National Bank issue, and so all of this created sort of a perfect storm for markets in India. Having done this so many years, I feel that what it's done is it's corrected valuations, it's corrected positioning, and it has reduced risk appetite. And all this sets a much better stage for the markets going forward than it did, say, in December of last year.
Yeah, absolutely. You know, just about every storm will come and go at some point. But Nandita, how is it that investors should approach this market? Do you try and catch the falling knife? Do you hide in spaces like IT or some of the road EPC companies which have been doing well? Or do you just wait and watch, sit on the sidelines, keep the powder dry and wait for the market to give you some amount of clarity that maybe all the negatives are in the price, and then perhaps jump in?
So I think what we're doing is we had some cash and we were waiting to deploy. So we're beginning to deploy the cash because we're finding that there are areas where valuations have become much more attractive. I think that if you look at some of the sectors which are cranking high growth, you've got domestic tourism, which is growing, close to 20% per annum. And that's creating opportunities in travel and leisure, in airlines, airports, those sectors. We're looking at the automobile industry. We've got the logistics sector, where the growth of e-commerce and much more sophisticated supply chains, thanks to the e-way bill and GST, is creating new opportunities. We're looking at media and entertainment, where I feel that this is the most underpenetrated sector in India, where the entire revenues of the media and entertainment industry are about $6 to $7 billion. In terms of per capita consumption of entertainment, it's about 1% of per capita GDP income. And so I think there's a lot of room to grow. We're very positive on TV advertising. We also think that the growth of broadband will have to come from the build out of broadband. And so we are positive on the cable and the distribution companies as well. So we are finding actually opportunities across various places. Some where growth is coming up. For example, the steel sector, which we've been positive on for almost 2 years now, and I'm very happy that I caught the cycle early. And I still feel that we're in the early stages of a very long-term upturn in steel in India. So we're in this correction, we're looking to add to our financials exposure, because I think that's one sector that acts as a beta on the upside and on the downside. And this time it looks like it's been beaten up severely.
Nandita, the challenge for Indian market really could be that good companies are not available cheap, and some of the good companies have hardly corrected in this kind of an reaction. So what does one do? Because the pockets which you identified, can clearly be captured by 3 or 4 companies in each of the sector. Unfortunately, all those good companies on good stocks are not available at throwaway prices.
So I think the way to look at it is really on a bottom-up basis. And, I've given you a handful of themes, but there are many, many more. And one of the things that I believe in doing very strongly is use these market downturns to buy the small and mid caps. So when other people shy away, I actually go in and I feel that there's a significant correction that's happened there. Some stocks have corrected 25-30%, and there's no reason why you loved them in November and December and you hate them in March. So yeah, I would be a little bit more bold. I am not saying compromise on quality, but I do think that there is a tremendous amount of runway ahead of us in even in consumer discretionaries, for example, in non-bank financial companies, in housing finance companies. So you really don't need to go down the quality curve, but you could go down the market cap curve.
Fair point. What are your top 3 holdings, and what are your key ideas which you think you are happy to own for next 4 or 5 years, and you're not scared because of the current leg of decline or volatility?
So we don't discuss individual stocks, I'm sorry. We're not going to be able to do that.
I'm just trying to get a flavor of your allocations.
But I could say broadly, one is so one is a large NBFC which is specializing in real estate financing. Another is a media and entertainment company, and the third could be a major steel company.
Okay. And what is it that you're staying away from, Nandita, in this market? While you've picked out the handful of sectors and not naming stocks, but what you're liking in this market and what you're nibbling in, but what is it that you're completely steering clear from? When you say financials, does that include PSBs as well?
Yeah, unfortunately, the public sector bank issue is very, very large, and it seems like it's a black box situation here. And I would like more clarity in what the Indian government is planning to do now that the jewelry scam has broken out. And I would like a little bit more transparency in terms of government policy towards public sector banks. I think that this government and previous governments have talked about bringing down their ownership below 50% over a period of time. But I would question, well, if they don't do it now, when would they do it? Seems to be a perfect opportunity where public opinion is with you to just stop this wastage of public finances and bring an end to the risk in the banking system. So I would strongly urge the government to take this opportunity and if not privatize the banks, at least bring down ownership and really come out and be very transparent about the path that they are choosing to take post the PNB issue and how they plan to resolve it. I think that these banks will have to shrink their balance sheets. To me, there's no question about that. What that means is that it opens up opportunities for both private sector banks as well as for NBFCs because these banks will be left with very little growth capital. So despite of the really positive signs that have come out from the resolution of the non-performing loans, which we've seen where the haircuts are actually lower than what the market was projecting, unfortunately what's happened is The disclosure norms will mean, and the scams will mean that there will be a shortage of growth capital going forward. So in a way, this sector will continue to shrink, but it does pose a systemic risk to India, and unless it is addressed very boldly by this government, and I must say that I am impressed by the government's bold stance on so many policies of the past few years, that they could actually get this done, hopefully, within a year or so.
So for now, PSBs are an avoid. What about other sectors? Anything that you're completely avoiding and stay aloof from at this point in time?
Well, we don't invest in cigarette companies.
Okay.
So yeah, that's something that's a very personal choice.
Fair point. And there are a lot of global funds who do have, these preferences. Nandita, the challenge for Indian market now really could be that interest rates are going higher and the headroom for P expansion could be limited. The earning recovery is still very patchy. Within the same sector, you've got no clear trend. You've got a Wipro which is struggling, but a TCS which is giving you a lot of promise. PSU banks are struggling, but private banks are going higher. So how do you reconcile market returns at a time when P multiples will not expand and earnings recovery may not be all that linear?
So I think you've touched upon two of my favorite topics. One is that India is a stock pickers market and it will always be. So there's no reconciliation. We've generated alpha through 14 years and we've outperformed the index consistently because we are better stock pickers, and that's what we do. And the second point is on cost of capital. I think that most investors are looking for a much lower interest rate regime in India. And we are concerned that India has missed the opportunity in the past 3 years when oil prices were extremely low, to bring down interest rates more and lower the cost of capital. In fact, I read yesterday Ray Dalio's interview, who said exactly this: why are interest rates so high in India? So we have an economy which is in the early stages of recovery, where real interest rates are 300 basis points. Well, clearly the RBI could encourage growth at this stage and shrink that. They've got a lot of room to shrink that and bring it to 100 basis points. I mean, China does it. China has done it. And if we are wanting to be on the same path as China, then we've got to bring in those policies as well. Cost of capital is something that is such a penalty for Indian corporate sector, for the real estate sector, and for valuations. So this is something that I feel very strongly about, and I would, encourage more voices to come out and speak openly about, why interest rates are not much lower.
My immediate follow-up question is on companies which don't require capital to grow, largely staples, some consumer names, brand owners in India. What is your view on the HULs, the Titans and the Page Industries of the world? These are great businesses, but the P multiples are trading at historic high. Titan is now trading at something like 70 times 1 year forward. So what should be the return expectation from some of these good companies which have a natural moat around them?
Low. So the return expectations should be low. And there is no reason why Titan should trade at those valuations. I think that the market participants have chosen it to be defined as a defensive when it really isn't. But having, and the same for Hindustan Unilever and so on. But this is something that's been going on for a while. There are much better ways of of generating alpha, and that's what we do. We don't believe in buying high and selling higher, because that's just not a game that works out in the end. So I would say that there are valuation mismatches across the board. And one fallacy in your argument is that companies will continue to, outside of FMCG, will continue to need capital. Well, if you see what's happened last year, we've had record flows into corporates, and companies have been able to raise record amount, about $27 billion were raised by Indian companies last year. And this year, I just spoke to an investment banker yesterday, $30 billion worth of fundraising will happen. What is this doing? This is shoring up the balance sheets of corporate India, and this is growth capital. So it's, a lot of companies have already raised the money. A lot of NBFCs have done the smart thing and raised the money. And so, and even FMCG companies require growth capital, not the ones you mentioned perhaps, but new FMCG companies will require capital. So I think there are some myths in this market that actually need to be addressed, and over time, investors, who are coming into the market will understand the difference in valuation.
And closing comments from you, a sector which in a sense has really surprised me personally, and I must confess I've got this one completely wrong, is the Indian retail sector. At a time when there was, we've seen disruption in the retail sector, and the basic brick and mortar model has got challenged because of Amazon and other US retailers. Indian retailers are just going from strength to strength, and the classic case here, Nandita, would be Avenue Supermart or DMart, which has now a commanding market cap of nearly 80,000 crore. So do you think the Indian brick and mortar retail sector per se is different?
I think it's here to stay. And not only Avenue, but also the Future Group has done extremely well in building out their retail models. And they're matured over a period of time as they reduce their debt and so on. And I think that the consumer likes to go shopping. So that's number one. The consumer is now faced with a tremendous array of choices, which you can see, when you walk into a grocery store. So whether it's your Patanjali or wellness products or the whole host of traditional FMCG companies, more and more choices and aspirations are driving growth of the sector. So I think it was only a matter of time. So it's not a new sector anymore. It's had to work hard. It's had to build its front end, and it's had to build its supply chain and its back end. And I think the companies that do a very efficient job of that, of maximizing revenues per square footage, at the same time building a very efficient just-in-time type of supply chain model, will be able to succeed very well. So yeah, so I'm actually very positive on the retail sector in India. I'm glad you brought that up.
Well, Nandita, an absolute pleasure to have you, and happy Women's Day once again. They often say that behind a successful man there is a woman, but in case of ET Now, the success of ET Now, I think, is also largely dependent on all the women power we have, and all thanks to my lovely colleagues at ET Now.